So Wednesday revealed the Fed minutes from their September meeting, and their comments were that they were going to keep short-term interest rates unchanged. And check out what happened to mortgage-backed securities. Remember, red is bad. Lower bond values means that you have to pay investors a higher yield to appeal to them. Higher yields equals higher interest rates. We've been saying to lock in for weeks with the sideways movement of bonds and with no ability to break through these tough levels of resistance. But believe me, the clients that had escrows moving and that were scheduled to close in the next 30 to 45 days are happy we were watching this so closely. First, some notes from those minutes. Information received since the Federal Open Market Committee met in September suggests that economic activity has been expanding at a moderate pace. Household spending is increasing at solid rates, and the housing sector has improved further. Consistent with its statutory mandate, which means what the Fed is there for, the committee seeks to foster maximum employment and price stability. They also continue to monitor inflation developments. To support continued progress toward maximum employment and price stability, the committee left rates unchanged. The Fed determined that continuing to buy mortgage-backed securities is prudent, even though they're not printing money to do it, which is what quantitative easing is. They're still buying mortgages, helping to keep interest rates low. Third quarter GDP came in at a low 1.5%, below the expectations of 1.6% and well below the 3.9% second quarter number. Our annual GDP remains at a low 2%, not very good. The consumer spending component was the big surprise and plays right into the Fed's statement that household spending has been increasing at solid rates. The Fed statement was hawkish in an effort to talk up rates and prepare the financial markets for a Fed rate hike at some point. The chance of a Fed rate hike in December is more likely than it was 24 hours ago or before on Tuesday, but it's still just a 50-50 probability. The mortgage market guide sees less of a chance of a hike, and they believe stocks may continue to push higher on more of the same: slow growth, low inflation, and low rates. And this may make it tough for bonds to move much higher. So remember all of the fun changes that have been occurring this year with Fannie Mae financing and Freddie Mac financing really starting to open up probabilities and possibilities for people to get more real estate loans. You don't need equity in your home now to be able to rent it out and use 75% of those rents to move into the next property. You don't need 2 years of tax returns if you receive an automated approval from either Fannie Mae or Freddie Mac verifying that you've had rentals the last 2 years. So a lot of these, Freddie Mac's also allowing 6 properties now, Fannie Mae still 10, and we still have our investor program that it doesn't matter how many properties you have or your clients have, we'll still finance 10 of them as long as they meet the guidelines, but we have loans that will finance 10 properties for investors no matter how many properties they have. Again, single family 1 to 4 units. Don't forget our keys on time guarantee and give us a call. We look forward to working with you. Take care.